before money begins to feel meaningful, it behaves in a way that is almost invisible to the human mind. Because in the earliest stages of accumulation, the relationship between effort and outcome is weak, delayed, and often disconnected from our natural expectations of progress. And this disconnect quietly shapes how people think about saving, investing, and even the value of time itself. Not through dramatic failure, but through subtle discouragement that feels logical rather than emotional. Imagine an individual who earns consistently, saves regularly, and follows what is generally considered responsible financial behavior. Yet after months or even years of effort, the visible results remain modest, almost underwhelming relative to the discipline required. And this creates a gap between input and feedback, where effort is clear but reward is not. And this gap becomes one of the most important psychological filters in financial life. Human behavior is strongly influenced by feedback loops, where visible progress reinforces consistency, and lack of visible progress weakens it. And in financial systems, the feedback loop is naturally delayed, especially in the beginning, because growth at a small scale is mathematically limited, meaning that even correct actions produce results that are too small to feel significant. And this creates a phase where rational behavior feels ineffective. At this stage, money behaves linearly, meaning that growth is almost entirely dependent on what you contribute, not on what already exists. And linear growth, while stable, lacks acceleration, and without acceleration there is no sense of momentum, and without momentum there is no psychological reinforcement, which is why many individuals begin to shift their behavior, not because they lack discipline, but because the system itself does not yet provide signals strong enough to sustain belief. This is where consumption begins to compete with accumulation, because consumption provides immediate feedback, immediate satisfaction, and immediate confirmation that your actions matter, while saving operates quietly, without visible reward. And this imbalance creates a natural pull toward short-term decisions, even among those who understand the long-term importance of financial stability. However, beneath this slow and often frustrating phase, a structural process is taking place, one that is not immediately visible but is fundamentally important, because each small contribution is not just adding to a total, it is building a base, and this base, once it reaches a certain scale, begins to interact with time in a different way. And this interaction is what eventually transforms the system from static to dynamic. The concept of a financial threshold is not about a specific number in isolation, but about a change in behavior of the system itself. Because when your capital base reaches a certain level, even modest percentage changes begin to produce outcomes that are noticeable. And this is where perception begins to shift. Because now growth is no longer entirely dependent on new input. It begins to emerge from the interaction between existing capital and time. Before this point, a percentage applied to a small base produces a result that feels insignificant, almost negligible, but as the base increases, the same percentage begins to generate outcomes that are large enough to be seen. And once outcomes become visible, they begin to influence behavior, creating a feedback loop where progress reinforces consistency, and consistency sustains the process long enough for compounding to take effect. This is not a sudden transformation, but a gradual one, where small changes in scale lead to changes in perception, and changes in perception lead to changes in behavior. And this sequence is what allows the system to evolve without requiring dramatic shifts in strategy or effort. At this stage, money begins to feel different, not because it has changed in nature, but because your interaction with it has changed. And one of the most important shifts occurs in how you perceive time. Because in the early phase, time feels like something you endure, a waiting period between effort and reward. But as the system begins to respond, time becomes an active component, something that contributes to outcomes rather than delaying them. This reinterpretation of time is subtle but powerful, because it changes how you evaluate decisions, particularly those involving trade-offs between present and future. And once time is seen as an ally rather than a cost, the appeal of immediate consumption begins to weaken, not through restriction, but through understanding. Spending, which once felt neutral or harmless, begins to carry a different weight. because it is no longer just a reduction in current resources, it becomes a reduction in future potential. And this awareness does not necessarily eliminate spending, but it changes its context, making it part of a broader system rather than an isolated action. As your capital base continues to grow, another shift begins to emerge, one related to optionality, because with more resources comes a wider range of possible decisions, and this expansion of choice changes how you approach problems, because you are no longer operating under strict constraints, and this reduction in constraint allows for more deliberate, forward-looking decisions rather than reactive ones. This phase also introduces the concept of interaction within the system, where decisions begin to influence each other over time, creating a network of cause and effect rather than isolated events. And this interconnectedness increases the importance of consistency, because each action contributes to a larger pattern rather than standing alone. Financial friction becomes more visible in this stage, because inefficiencies that were previously hidden within slow growth now begin to produce noticeable effects, and this visibility allows for refinement, where adjustments can be made based on observation rather than assumption, improving the efficiency of the system over time. Risk perception also evolves, moving from a binary view of gain versus loss to a more nuanced understanding of probability, time horizon, and system resilience, and this shift reduces emotional volatility, because decisions are no longer judged solely on immediate outcomes, but on how they contribute to the overall structure. Opportunity cost becomes more tangible, as each decision represents not just what is chosen, but what is foregone, and as the system grows, these trade-offs become more significant, shaping the direction of future outcomes in a more pronounced way. Time, once again, plays a central role, but now it acts as a filter, determining which actions have lasting impact and which ones fade, encouraging a longer perspective, where short-term fluctuations are seen within a broader trajectory. Identity begins to shift as well, moving from externally influenced behavior to internally guided decision-making, where actions are based on an understanding of the system, rather than social comparison or immediate gratification. And this internal alignment reduces the need for constant decision-making. As many behaviors become structured and automatic, effort itself begins to change in nature, becoming more strategic rather than mechanical, as the focus shifts from simply contributing resources to optimizing the system that manages those resources. And this creates a second layer of compounding, where improvements in structure lead to improvements in outcomes. Simplicity becomes increasingly valuable, as complex systems often introduce new forms of friction, while simple systems are easier to maintain, understand, and adapt. And this simplicity supports long-term consistency. At a broader level, your personal financial system begins to interact with external systems, such as economic cycles and market structures, and this interaction requires adaptability, where decisions are made with an awareness of changing conditions, rather than fixed expectations. Progress becomes less about reaching specific numbers, and more about maintaining system integrity, ensuring that the structure remains functional and aligned over time. And this shift reduces pressure, replacing it with stability. Patience transforms from waiting into participation, as time becomes an active contributor to outcomes, reinforcing consistency and reducing the need for reactive decisions. Resilience emerges as a defining characteristic, allowing the system to absorb disruptions and continue functioning across different conditions, supporting long-term continuity. What develops over time is a self-reinforcing loop, where growth supports behavior, behavior supports structure, and structure supports further growth, creating stability through interaction rather than intensity. When viewed as a whole, the journey from early accumulation to system-driven growth is not a series of disconnected phases, but a continuous evolution, where each stage builds upon the previous one. And understanding this progression allows you to interpret slow beginnings and accelerated growth as parts of the same process. The significance of financial thresholds lies not in the numbers themselves, but in the changes they represent in how money behaves, how time is perceived, and how decisions are made. And this understanding provides clarity, allowing you to navigate the system with awareness rather than expectation. And in that awareness, the system continues to operate, quietly and consistently, shaped by the interaction between effort, done, and structure, gradually evolving without the need for dramatic change, but through steady and continuous participation.